Hello everyone, this is Rob Lloyd with Lloyd's Intrepid Wealth Management with a monthly market update on the markets and the economy. Today's video discusses our national debt. There's tremendous fear that we're spending ourselves into oblivion, and while the situation isn't great, we aren't on the verge of an economic collapse. Why do we care? High interest rates and enormous budget deficits are creating record levels of debt sales and interest expense for the government. Many fear how this gets resolved. Are we going to see higher taxes? Are we going to see cuts to major programs? Are we going to see runaway inflation like the 1970s? Investors are particularly worried. Higher taxes will impact margins and earnings, and inflation erodes away the spending value of bond interest. So let's look at the actual data and see if the doomsayers are correct. Where do deficits come from? Well, first, you have to just figure out where revenue is coming from. Revenue comes from taxes and tariffs. For the federal government, payroll taxes and income taxes are the two primary sources of revenue for the government. Of course, they spend that money. The two biggest programs for spending are Social Security and healthcare. These are non-discretionary programs and there's no negotiation. If the bill comes in, they pay it. The difference between spending and revenue is the deficit. In other words, they borrow money to pay for the excess of spending over revenue. That translates into debt. And so here I have a slide that shows the total government debt over the last 20 years. You can see it was below $10 trillion about 20 years ago. And then we got into the 2010s, it got over 20 trillion. And after the pandemic, it got up to over $30 trillion. So it's a really big number. Another way to look at debt and government spending is to divide it by the GDP level. And so here we have revenue as a percent of GDP. This adjusts for the increase in the economy as we go forward in time and gives you a sense for the relative size of the government as a percent of the economy. So beginning in 1900 all the way through roughly 2025, because this is a forecast, you can see that the percentage of GDP that was allocated towards government revenue increased fairly steadily up until the mid-80s. And then in the 1990s kind of settled out. Here you can see the dips in revenue during the technology bear market and the financial crisis. And of course, the lack of real reduction in spending as a percent of GDP during the pandemic. Just as we can look at this analysis for revenue, we can do the same thing for spending. So spending as a percent of GDP started out at a very low level in 1900. You can see that in World War I and World War II, there were tremendous spikes in spending. But spending as a percent of GDP rose fairly steadily all the way up to the late 1990s. And you can see there was a little spike during the financial crisis and, of course, during the pandemic. Remember, the deficit is just the difference between the spending and the revenue as it comes in. And so we can do the same analysis here, looking at deficit as a percent of GDP. And so 1918, you can see there's a big spike there for World War I and another big spike for World War II. So this all makes sense. And the deficits dropped after World War II, but began to gradually increase as we got into the 1970s and the 1980s. They dropped off in the late 90s and then resumed during the financial crisis and the pandemic. But the key takeaway here is that as a percent of GDP, the deficits that we're experiencing today post-pandemic are not too much higher than what we've seen in prior decades. Another concern is interest expense. So let's look at interest expense as a percent of GDP. And we can see that going into the 1970s and the 1980s, as interest rates increased, the interest expense of the federal government, really all government entities, federal, state, and local, increased dramatically from about 1.5% to 4% of GDP. And then as we went through the 1990s and inflation began to ebb, you saw the inflation component or the inflation expense as a percent of GDP also fell dramatically. Now we're looking for an increase in this interest expense as a percent of GDP as inflation and interest rates have moved back up. But so far, we're not forecasting a return to the highs that we saw in the 1990s. This is all going to be dependent upon the size of the budget deficit and the height of interest rates as we go forward in time. We still have long-term problems with this setup. In other words, the longer we wait paying off or stabilizing the deficit, the more the interest will compound on the national debt and become a significant factor. And so on this slide here, we're looking at deficits and the primary deficit, the interest outlays on top of the national debt, increasing dramatically as we go forward in time. So even though today there's no crisis, eventually we're going to have to deal with this problem, either through higher taxes, lower spending, or better growth. Let's take a look at the major markets. The bond market, for those of you that don't know, has been in a sorry state for the last 3 years. You can see that it's declined about 22%. This is a 5-year chart we're looking at. So from the peak in 2020 to the trough in late 2021, the bond market declined about 22%. It looks like, though, we have a small bottom put in place. And so we've seen the inflation numbers begin to fall. The Fed, it looks like they're almost done with their rate increases and the economy is decelerating. These are all really good things from a bond investor's perspective, because falling inflation and falling growth mean that the real return on your bond interest payments are going to increase. The stock market, on the other hand, is still looking quite positive. So this is also a 5-year chart. So you can see the pandemic sell-off there in 2020. And we're in a confirmed uptrend, a longer-term uptrend. But interestingly enough, this latest rally, which we've defined as a bear market rally, did not create new highs. And so we have this overhead downtrend line competing with this longer term uptrend line. And so the real question is, which way does this market go? Now, the Federal Reserve raising interest rates is slowing things down. And so we would eventually expect that to hit earnings. And of course, if earnings fall, then you would expect the stock market to fall with it. If we zoom in on a narrower piece of the stock market and just look at the daily return, this is a daily 1-year chart, we can see that we have this very interesting structure where we have a potential head and shoulders. Now, this usually indicates a change in trend, a change in direction. And so we have these 3 peaks, and we're going to have to wait and see over the next coming days whether the right side of this head and shoulders pattern gets completed, which would imply that the market is ready to move back down again. Thank you very much for joining me today. I hope you enjoyed our discussion about the national debt. It's a pretty boring topic, but it's very important if you're a bond investor like we are. And if you have any questions, you can reach out to us at the telephone number below. And if you don't mind giving us a like, that would be very helpful. Thank you very much and have a great day.